Hello everybody and welcome to this video on dividend investing. If you're interested in learning more about how to earn passive income through dividends, then you're in the right place. In this video, we will cover the basics of dividend investing. We'll conclude what dividends are, and we're going to talk about how they work, as well as some tips in finding dividend investing through ETFs, through stocks, and we're going to talk about some of the risks when it comes to dividend investing, aka passive income investing. So let's dive right into this. So what exactly are dividends? Simply put, dividends are payments that a company makes to their shareholders. These payments are typically made in the form of cash, but they can also be made in the form of shares and in the form of equipment. Dividends are usually paid out on a regular basis, such as quarterly or annually, but you could get dividend payments on who knows when they're going to come. For example, a company like Costco, which gives a dividend payout that's super lucrative, but you have no idea when that payout is actually going to be. So how exactly do dividend payments work? When a company makes a profit, it has a few options for what to do with the money. One option is to actually pay dividends to shareholders. This can be a good way for a company to return value to its investors while also potentially attracting new investors who are looking for a reliable source of income. To receive these dividend payments, you need to own shares in the company that's paying out the dividends. There's usually a cutoff point to when you have to own shares of the company in order to be eligible for those dividend payments. The amount of dividends you receive will depend on the number of shares you own and the dividend rate, which is a percentage of the company's profits that is being paid out as dividends. For example, if a company has a dividend payment of 3% and you own 100 shares, then you would receive a $3 dividend payment for every $100 of profit that company makes. There are several different types of dividends that a company can actually pay. The most common one is a cash dividend, which is exactly what it sounds like, a payment in cash to shareholders. There's also a stock dividend, which involves a company issuing additional shares of stock to shareholders, and property dividends, which involves the company distributing non-cash assets to their shareholders. In terms of the dividend investing when it comes to shares, think the splits, the stock splits. For example, Tesla announced a dividend payout of shares, and then you got a 3-to-1 dividend payout of shares. That's all it is at the end of the day. So why might you consider investing in dividends as part of your investment strategies? There's a few key benefits to consider. First, dividends can provide a reliable source of income. If you're looking for a great way to generate passive incomes, dividends can be a good option. Many companies have a long history of paying dividends that can often increase their dividends over time. This can help you build a stream of income that you can count on. Second, dividends can serve as a cushion during a market downturn, aka, i.e., right mother effing now. When everything is going down, dividends seem to be a lot safer of a play. Less risk, less reward, but definitely a lot less steady than it comes to non-dividend investing. However, it's not all peaches and cream. It's not all gravy, baby. And dividend investing also holds some potential risk, which I'll go over in just a moment. When the stock market is performing poorly, dividends can help offset some of the losses you may be experiencing in your portfolio, which allows you to ride out market fluctuations and invest in the long term. Let's talk about some tips when you're investing in dividend investing, and then I'm going to go over some specific ETFs, some specific stocks, and then I'm going to go over the risks of dividend investing, passive income investing. But before we go any further, I want to ask you guys for a favor. I need you to destroy, discombobulate, and dismantle the like button. Put it in a chokehold. I want you to actually deploy mass destruction to the like button. I need two things to happen when you hit the like button. Number one, I need YouTube to give me a call and be like, yo, Adam, your subscribers are hitting that like button so freaking hard that we need to back charge you to fix the like button because it's not working anymore for any other YouTuber. And two, I need a call from Graham Stephan because he loves the like button. And when you destroy the like button on the Adam Bergman show, he's going to get very, very angry and he's going to give me a call and be like, yo, Adam, tell your subs to stop killing that like button. I'm not appreciating it. So before you invest in dividend investing, in passive income, I'm going to give you a tip. This tip actually holds true whether you're investing in dividend stocks and not investing in dividend stocks and investing in anything that you do in your life. Research potential investments carefully. Look for companies that have a track record of stable or increasing dividends and a strong financial foundation. Diversification in your portfolio. Don't put all your eggs into one basket. You remember those phrases? Well, those phrases actually hold true, especially in economic downturns. There are many different dividend-paying stocks and ETFs, which stands for exchange-traded funds, to choose from. And the most common ones will depend on the specific market or industry you're interested in. There's different niches and subcategories of pretty much any industry you could possibly imagine that you can invest in when it comes to dividend investing and passive income investing. However, some of the most common dividend-paying stocks and ETFs generally include blue chip stocks. So these are stocks of well-established, financially stable companies with a track record of dividends. For example, blue chip stocks include IBM, Johnson & Johnson, Procter & Gamble, Pfizer, so on and so forth. Basically, staples of America, you could say. Now, there's a lot more companies. You guys could definitely do your own research. For me, I'll save it to the end. I'm going to tell you one of the really good dividend stocks that I like, one of the good dividend plays that also has some growth in the future. I'll let you guys know in just a moment. Let me finish up this video. So definitely sit back, relax, enjoy the rest of this video, and wait until the end, and I'll reveal to you what dividend stock investing I like to invest into. Now, there are something called dividend aristocrats, and a dividend aristocrat is a company that's been paying dividends for 25 consecutive years without ever stopping. So this includes companies like a McDonald's, like a Coca-Cola, like a 3M, and there's definitely a lot more. These are literally the backbone of America. These are companies that are as American as the English language. Now, I know the English language is not American, it is British, but you guys get what I'm saying, right? You could also invest in utilities, the subsector of utilities. These are stocks that are companies that provide essential services such as electricity, gas, or water. Many utilities pay dividends as they have a stable and predictable earnings. Examples of utility stocks include Duke Energy, Southern Company, or Dominion Energy. Again, there are many other energy companies. Those are just a few. Then you have something called a REIT, which stands for a Real Estate Investment Trust. Now, I'm very iffy on REITs. A REIT is an investment vehicle for real estate, commercial, single family, malls, so on and so forth, public storages. I prefer to invest directly into real estate, but I understand some people don't want to take the time to do that. Some people don't want to deal with that. And there are investment vehicles for real estate where you can go as part of a conglomerate. You don't have to be your own real estate investor. The reason why I don't like REITs is you get a share of the rent collected. You don't get any tax benefits. Dividend investing, passive income investing, all the dividends that you're getting is short-term capital gains. So if you're investing into real estate, one of the reasons you invest in real estate is to get tax benefits. Mortgage write-offs and depreciation of rent. Those are the main ones that you want. But more specifically, the actual depreciation of property against your rent roll. Basically, you save 25% of taxes, plus or minus, from my experiences. You don't get that investing in a REIT. However, you also don't get any of the headaches dealing with real estate. If you do want to invest in REITs, there are a couple of really good REITs. For example, Simon Property Group, Public Storage, and Equity Residential. And if you don't want to pick a specific stock or a specific sector, you can invest in an ETF, which stands for an exchange-traded fund. And again, when you invest in an exchange-traded fund, you can have a specific niche or specific subsector, or in general, a global, or in general, a United States, so on and so forth. Again, different courses for different horses. Some of these ETFs are the Vanguard Dividend Appreciation ETF. You could do the iShares Selected Dividend ETF. You could do the Charles Schwab Dividend ETF, so on and so forth. It is important to keep in mind that when you're investing in any individual stock or ETF stock, there are risks, and you should be careful when considering your investment options before making these decisions. Now, it's very important to understand that when you're investing in any of these individual stocks or ETFs, there are inherent risks, and you should understand the inherent risks when you invest in dividend stocks, when you have a passive income portfolio or passive income strategy, because these risks are usually overlooked because these are considered to be very steady investments, very safe investments. However, although it doesn't happen often, it does in fact happen, and it actually happened during coronavirus. So let me go into some of the risks when it comes to investing into dividend stocks and dividend ETFs. So you can have a company-specific risks. When you invest in a particular company, you're exposed to the risks of that specific company. For example, if the company's profits are on the decline, it could face financial difficulties or legal problems that could negatively impact the ability to pay dividends or reduce dividends or completely just get rid of the dividends altogether. And if that happens, the share price of the company is also going to suffer because all of a sudden, hey, if you don't have money for dividends or reduced dividends, that means that your company is getting closer to insolvency or bankruptcy, and that's the perceived notion. Besides, for an individual company risks, there's something called market risks, and this happened during the downturn of coronavirus, specifically in real estate. I'm going to give you one very specific example. Dividends paying stocks and ETFs are subject to market risks, right? Which are risks that are inherent to the stock market as an entire whole. These risks include market volatility, economic downturns, and changes in interest rates. In the market, if the market performs poorly, the value of the dividend paying investments could decline as well. So Simon Properties, I mentioned this earlier as one of the REITs. They are the largest or second largest real estate holder in malls throughout the United States. They reduced their dividend payment significantly during coronavirus because specifically commercial real estate suffered like crazy. All businesses closed, right, for over a year. And because businesses closed, nobody was paying rent. And a lot of businesses started going out of business. Think about huge businesses like a Sears, like a Macy's, these huge mega brands in the malls, they pay a shit ton of rent. So if they're going out of business or there's a perceived risk of them going out of business, well, nobody's paying rent. And they had all of these governmental programs where people can get away with not paying rent. That happened to me on the residential side. 2 years, I couldn't collect any rent. I couldn't kick somebody out. It is what it is. And I had to take a big L on that investment deal. So if this happens to you, it really sucks. There's also something called a credit risk, where if the company has credit, they can default on credit. If the company defaults on credit, again, your dividend payments is at risks. There's challenges to the company. Finally, interest rates in society. Right now, interest rates are going up. For example, the 10-year treasury. The 10-year treasury is right around 4%. The thing is, most of these dividend plays, not all of them, but a lot of them are paying between 2 and 4%. Those ones that are giving you 10%, 12%, 8%, so on and so forth, they're there. But the most stable aristocrat stocks that pay dividends are paying 2 to 4%. Well, if you can get a treasury bond that's giving you 4% guaranteed, why would you do a risky stock play? That you're not investing in a dividend play for appreciation of the stock. You're investing in a dividend play for the dividend payouts. Now you have a treasury bond that's paying you guaranteed 4%. Also, if you live in 41 of the states that you have to pay unreasonable, unjust, and super high taxes, if you buy a treasury bond, you don't have to pay taxes on the state level. That's a plus. So you get an additional tax benefit. So that treasury bond is probably worth 20% more, 30% more, 10% more, whatever, because you don't have to pay state tax levels. These all have a huge factor when it comes into your passive income strategy. So I'm going to give you a final talk about what I believe is a very, very, very strong play for a dividend or passive income play. A passive income dividend stock, for me, my number one pick, and again, this is not financial advice, purely entertainment education, would be Walmart. Walmart pays a very hefty dividend payment, and I believe that Walmart is actually going to appreciate in value. The share price of Walmart is actually going to go up in the future. Right now, it sucks. For 2023, there's going to be crazy deals when it comes to Walmart because there's going to be an earnings recession. However, there is going to be a massive boom after 2023. In my personal opinion, I could be completely wrong. I got so many things wrong until this point. I'm just sharing you my opinion. What's good for me might not be good for you, and vice versa. Walmart. Also, Rio Tinto, which has a partnership with Palantir, is paying a very hefty dividend payment. Last time I checked, my man Aryu from the Patreon group told me about this stock. The reason I know about this stock is because, again, it is a partner with Palantir, as you guys know on this channel. And if you don't know, I am a huge Palantir bull, a huge Palantir investor. So Rio Tinto is paying you, I believe, 12% for the year. And Rio Tinto is a miner of minerals and natural elements, things like that. I hope you enjoyed this video. Thank you so much and have a great day.